manufacturing company, financial statement analysis. So I'll be explaining a case study on Anandam manufacturing company with a focus on financial statement analysis. Financial statements are the backbone of any business. They provide a vital information about the company's financial performance as well as the position of the company. However, the raw numbers alone do not give the meaningful insights. That's why we use your financial analysis. Financial statement analysis helps us to interpret the financial data, evaluate the business performance, compare the past and the present results, making the strategic decisions. So in this case, we will apply the theoretical concepts to understand how another manufacturing company performs financially. Yeah.
Explain a concept of financial statement analysis. Financial statement analysis is the systematic and logical process of examining financial reports. It involves classification of financial data comprising of figures, interpretations of results. It converts accounting data into useful information for different stakeholders. Managers for planning and control, investors for investment decision, creditors for assessing the repayment capacity.
Let us explain about the objectives of the analysis. What would be the main objective of your financial statement analysis?
Yeah, so the main objectives of analyzing unmanned manufacturing companies are to measure profitability, to evaluate liquidity, to analyze solvency, to increase efficiency, to identify the strength and weakness, and to assist in decision making and future planning. These are the objectives to ensure a comprehensive evaluation of the company.
So there are about various types of the financial statements which are used in the analysis part. Can anyone explain what are the different types of your financial statements used?
In this case, the three main financial statements are considered. The first one is income statement, show revenue and expenses, help determine profit and loss. The second one is the balance sheet, show assets, liabilities and equities, indicate financial positions. And the third is cash flow statement. Cash inflow and outflow of the companies reflect liquidity in the real term. Together, the statement provide a complete financial pictures. The tool and the technical of the analysis. Different tools are used to analyze financial statement effectively. The first tool is ratio analysis. This is the most widely used in techniques. Ratio establishes relationship between financial variables. The types of ratio is profitability ratios, liquidity ratios, and solvency ratios, and active ratios. Comprehensive financial statements compare financial data across different years. It helps identify trends and growth of the patterns. And third is common sense statement, convert figure into a percentage and helps understand cost and revenue structures. And fourth is trend analysis performance over time and useful for forecasting future performance. This tool simplify complex financial data into understandable insights.
So next we are going to see the step-by-step process which is involved in the analysis of your financial statement. Now Vignesh is going to explain all those steps.
Step 1, probability analysis. Probability indicates the company has earning capacity. The high gross profit ratio means efficiency, production and cost control. The high net profit ratio shows overall business success. The low operating ratio indicates cost efficiency. The Anandam manufacturing company, probability in strong. The company is able to control production and operating cost. It generates reasonable return from its operations. The reflex of healthy and earning positions. Step 2, liquidity analysis. Liquidity analysis to ability to meet short-term abilities. Current ratio ensures working capital. Quick ratio check immediate solvency. Interpretation it too low on receipt of interpretation. If liquidity is too low, risk of insolvency. If too high, efficiency used on funds. In this case, the company maintains the high liquidity positions. It can easily pay short-term obligations. Working capital management effective. This ensures smooth day-to-day of operations. Step 3, solvency analysis in depth. Solvency focus on long-term financial stability. Debt equity ratio indicates financial structure. Interest coverage ratio measure ability to pay interest. Interpretation: low debit, low finance risk. High coverage, strong repayment capacity. In manufacturing companies, debit is under control. The company is not heavily dependent on borrowing. If can comfortably meet interest obligations. Financial stability and low risk. Step 4. Efficiency of activity analysis in depth. Efficiency ratio measure how efficiency resources are used. Assets turnover ratio. Efficiency is used total asset. Inventory turnover ratio. Stock management efficiency. Interpretation. Higher ratio indicates better efficiency. In case inventory is well managed, assets are moderately utilized. This suggests that this is the scope of improving asset productivity. Better can increase revenue. Overall financial position analyzed. Probability strong, liquidity satisfactory, solvency stable, efficiency moderate. This indicates the manufacturing company is financially sound.
It's operationally stable as well as it has the capability for growth. It has highly capable of growth. So, however, some improvements are being needed for your better performance of the company. So, can anyone explain the key insights which is used in the criteria evaluation?
The key insights from the analysis we take the important insight, positive aspects, strong earning capacity, good working capital management, low financial risk, stable operations, and the area of concern, high operation cost, analysis of assets, scope of efficiency improvement. These insights helps management focus on the key areas. Suggestions to improve financial performance, the company should control operating expenses, increase asset utilization, adopt advanced technology, improve production efficiency, expand market reach and sales, strengthen financial planning and budgeting. These strategies will enhance profitability and long-term growth. Limitation of financial analysis. While financial analysis is useful, it has some limitation based on the past data. Ignores validative factors affected by the accounting policies, does not consider market conditions. Therefore, results should be interpreted carefully.
So, to conclude with this case, the financial statement analysis of your Anandam manufacturing company reveals that the company is financially healthy as well as profitable, as well as the financial position of the company is stable. It maintains a good balance between your profitability, liquidity, as well as the solvency of the company. However, improving efficiency and reducing cost will further strengthen the financial position of the company. Overall, the company has strong potential for your future growth as well as your sustainability. Thank you for your cooperation. Thank you.